Welcome to the State of the Tape. Don't get wrecked here. We'll break down Friday's market flush, why it happened, and what to expect next week. Friday's events were not a surprise, but a setup we anticipated weeks ago. This video offers the complete roadmap and explains why next week will be the decisive one. This brief contains 11 sections, focusing on the receipts, the damage, the mechanism, rotation, reading the tape, the Sentinel, lines in the sand, next week's focus, and the playbook. Section 1 covers the receipts, what we called, documented, and made public before the market move ever happened. Our thesis predicted a pre-IPO liquidity drain, forcing a tech sell-off. The trade involved being long QQQ during the event, resulting in a mapped flush with NDX down minus 4.77%. We documented this setup on social media before it happened. The tape confirmed the analysis, showing the Nasdaq's worst fall since April 2025. Receipts don't lie. The scorecard confirms 4 successful calls: the liquidity drain thesis, flagging market exhaustion signals, the QQQ trade, and the resulting exact flush outcome. Section 2 focuses on the damage. Friday was the worst day for the Nasdaq since April 2025, and traders fled the chip sector. The Nasdaq 100 closed down minus 4.77% in a single session, shaving roughly 1,375 points off the week. Wall Street leaders drove the decline. The damage was widespread, but tech suffered the most. The Nasdaq Composite dropped minus 4.18%, S&P 500 minus 2.64%, Dow minus 1.35%, and Russell 2000 minus 3.5%. The Semiconductor Index, SMH, was gutted, falling minus 9.2%. Leveraged ETFs like SOXL and TQQQ saw massive losses, with leverage cutting both ways. Volatility woke up, with the VIX spiking plus 40% to roughly 21.5. Historically, a VIX update greater than 20% suggests a bounce in the next 2 sessions. It was a risk-off environment everywhere. Highest beta winners, including Bitcoin, which dropped below $60,000 and was minus 29% off its high, bled the most. The jobs twist reinforced the idea that good news is bad news. Strong job data, combined with high prices, means higher for longer interest rates and surging 10-year yields. The VIX was the ticking time bomb under a market drowning in calls. On Friday, the fuse went off. Section 3, titled The Mechanism, explores how this happened. It involves one pool of capital, 4 strains, and a subsequent drain. This perfect storm was driven by 5 fault lines: liquidity drain, leverage unwind, anchors fail, buybacks gone, hot data, and exhaustion. They all said the same thing. Fault line 1 is the liquidity drain. The biggest IPO in history dropped into the most cash-starved window in years. Funds sold winners to raise cash for an allocation. To be clear, fund managers don't receive new money for the IPO. They sell their tech winners. The drain occurs before the hype, not after. Fault line 2 is leverage unwind. SOXL dropped minus 35% across 2 days. Triple leveraged ETFs must sell into the close to rebalance debt, pushing more selling into the lows. Fault line 3 is anchors fail. NVDA failed to reclaim a key level, and Broadcom chips guided light. Mega caps could not hold the line, accelerating the broader market fall. Fault line 4 is buybacks gone. Google and Meta cut buybacks. Software hasn't bottomed, and the market's liquidity story is a myth, removing a significant source of buying pressure. Fault line 5 is hot data. Jobs reported hot, yields up, and rate cut hope died. Oil and yields squeezed the multiple, further pressuring market valuations. Fault line 6 is exhaustion. The 9th of September 13 count and a gravestone doji were signals of a top. Divergence appeared on every important oscillator, indicating a market on the brink. The key takeaway is that the $1.3 trillion pool of capital is finite. Selling from one group of players impacts the others, creating a domino effect across the market. Section 4 discusses rotation. The common narrative is to buy the dip, but that's a trap. A true rotation involves capital moving out of tech and into other sectors. Money flowed into materials, energy, and industrials before the tech crash. Tech was the last place to be for those seeking performance. This flow suggests a genuine rotation. As money moved from high beta tech to traditional sectors, the narrative shifted from TINA to there is another alternative. The S&P 500 closed the week flat, while the Nasdaq was down minus 4.77%. The performance disparity confirms this rotation, with sectors like materials and energy leading the way. Section 5 is about reading the tape. The market gave clear warning signs before the crash, including divergence in price and momentum. The first warning was the divergence between the Nasdaq and the relative strength index. The price reached new highs, but momentum peaked days earlier, indicating diminishing buying power. Second, the market structure warned of a breakdown. The daily chart showed a weakening structure, followed by a lower high and a complete breakdown of support levels. Third, the technical count confirmed the impending drop. The 9th of September 13 count on the daily chart warned of a possible reversal, which played out perfectly. Fourth, the gravestone doji signaled rejection at a key resistance level. This candlestick pattern, combined with the technical count, confirmed the market top. Section 6 is about the Sentinel, the single most important metric for the market. It is the 2-year yield, which controls the valuation multiple. As long as the 2-year yield is rising, it suppresses market valuations. Friday's hot jobs data pushed yields up, acting as a crucial headwind for tech. Section 7 covers lines in the sand, the key support levels that must hold to prevent further downside. The S&P 500 must hold 5,100, and the Nasdaq 100 must hold 17,200. The 5,100 level on the S&P 500 is critical. A break below this level could trigger a move down toward the 4,900 support zone. The Nasdaq 100 must find support at 17,200. This is the last stop before a potential retest of the previous lows, which is a key downside risk. Section 8, next week's focus, highlights that the market will remain volatile. Traders must be ready for a bounce or a continued fall. The key data points next week are inflation reports and Fed commentary, which will influence the 2-year yield and market sentiment. Section 9 presents the playbook. The overarching strategy is to trade the range and avoid getting caught in the volatility traps. The bearish playbook involves scaling into shorts if key support levels fail, targeting 5,000 and 4,900 on the S&P 500. The bullish playbook focuses on buying weakness near support, anticipating a bounce back toward the resistance level of 5,200. To summarize, the market has flushed, but the key is to manage risk, stick to the levels, and prepare for a decisive week ahead. Thank you for watching this video. The lowercase quote signals a failed retest. Price runs up, rolls over, and fails to retest the high, forming the H shape. The right shoulder is your short. This can appear as evening stars or double tops on different time frames. The double top is the M that ends rallies. It features 2 peaks at the same level with a dip in between, like the letter M. Breaking the neckline signals a trend change, not just a pause. Reading the top in real time on the Nasdaq 4-hour chart reveals a tweezer or double top, indicating supply is parked. Look for an engulf trap in a failed morning star. Overcomplicate nothing. The shape is the signal. The 1-hour tells on the Nasdaq show a bear flag or pennant, stacking multiple bearish signals. An evening star confirms the momentum shift to sellers. The lowercase h signals a failed retest. Break the yellow line and get out fast. The signs come early. On being a purist, remember it doesn't have to be perfect. Get creative with how you see charts, but always respect the daily time frame. Carry this pattern cheat sheet for your edge. Key patterns include tops like evening star and double top, continuations like falling 3 methods, and reversals up, such as morning star and engulfing. Section 6 introduces the HPT Sentinel. This system reads the tape for you, allowing you to act before retail traders do. The 5-5 EMA rule is the most useful line on the chart, representing the institutional trend line. Breaking it means institutions are throwing up the stock. Trading above it gives the benefit of the doubt. Below it means getting out, as big money has left. Breaking the 5-5 EMA signifies institutions dumping, as seen in the Nasdaq 4-hour Sentinel read. Key points include a swing high before the break, conviction volume indicating real distribution, and an oversold RSI. Also, look for an FVG overhead, which acts as a magnet to fade. The daily picture on Nasdaq 1D shows an undercut, retest, and the 50% zone. Notice the undercut retest with a Marubozu and dark cloud cover. The 5-5 EMA retest acts as the first magnet on any bounce. The 50% zone is the 7% lower Fibonacci pivot that determines bull versus bear action. The volume regime ranges from low to the most volume we have seen. RVOL, or relative volume, stacks today's volume against the average. CVD/delta shows who is hitting the bid versus the offer. A real thrust down indicates real distribution. Believe the read when volume increases from quiet to loudest on a down day. Always keep an eye on the rate of change 0 line. It's the momentum waterline. Above it, bulls have control. Below, bears do. A break below 0 gives early heads up before big candles appear. A bear lean means every short time frame has a negative ROC, signaling a lined up sell. RSI discipline is key. The 70 rule is a mechanical exit. When RSI breaks back down from 70, I'm out. Divergence occurs when price makes higher highs, but RSI makes lower highs, front-running the drop. Always weigh the higher timeframe RSI. A daily one matters most. The 50% concept on S&P daily dictates above is bullish, below is bearish. The 50% line is the pivot of the move. Above it, look for longs into supply. Below it, it's bearish, favoring shorts. Remember that time frames matter when measuring the swing for your 50%. How I use fibs is simple. Know where the 50% line is. Above it is bullish. Below it is bearish. The whole trick is being cognizant of the time frame. Let's look at the supply overhead on the S&P 2-hour chart, focusing on the golden FVG zones to fade. We have stacked fair value gaps overhead, providing unfilled supply for the bounce to fight through. Analyzing demand below on the S&P daily chart shows where buyers might actually live. The daily fair value gap below price is the first real demand shelf. Losing the 5-5 EMA support turns the picture ugly. The Sentinel dashboard offers key readouts. Active FVG indicates live bullish or bearish fair value gaps. Golden FVG are the highest probability gaps for trading. Mitigated gaps lose their magnetism once tagged. The hierarchy rule states, daily is king. Lower timeframes give you early signs, but the daily provides the verdict. Never fight the daily trend on a 5-minute chart. Confluence is vital. 1 signal is a guess, 5 is a trade. Stack patterns, the 5-5 EMA, 50% fib, volume, and RSI all pointing the same way. If they align, that's the spot. Otherwise, wait. No confluence, no trade. Now let's examine recent market action, focusing on the state of the tape. These scenes track the market context leading up to June 5th. Looking at the Nasdaq daily chart from March 2023, notice the gap below price, acting as a magnet. The 5-5 EMA serves as primary support, maintaining the uptrend. The 4-hour Nasdaq chart shows the setup heading into Memorial Day. A swing high formed with a golden FVG overhead. The 5-5 EMA remains intact, signaling continued bullish control. On the Nasdaq 4-hour chart, the push into supply starts. Watch for early signs of exhaustion before the trend reverses. The volume regime indicates expansion. A closer look at the Nasdaq 4-hour chart reveals a tweezer top, indicating supply presence. The 5-5 EMA is broken, signaling a shift in institutional sentiment. The Nasdaq daily chart shows the 5-5 EMA break. This break confirms the bearish turn. The momentum shift is clear, with the 5-5 EMA failing to hold as support. Examining the Nasdaq daily chart, a retest of the broken 5-5 EMA acts as resistance. This confirms the new bearish bias and provides an opportunity to initiate shorts. The Nasdaq 4-hour chart illustrates the downside targets. Price is seeking demand, and the next key level is the first FVG below, which is acting as a demand shelf. On the Nasdaq daily chart, the move finds demand at the FVG. Price starts to consolidate after hitting the demand zone. Pay attention to the volume and RSI in this area for potential reversals. The S&P daily chart shows the overall picture heading into June. The 5-5 EMA is holding, suggesting underlying strength despite the Nasdaq weakness. This divergence is important to note. The S&P 4-hour chart reveals a tweezer top at a golden FVG. This suggests the market is setting up for a potential short trade, even if the daily chart still shows strength. Looking at the S&P 4-hour chart again, we see the 5-5 EMA break. This break is a clear warning sign of institutional distribution, echoing the Nasdaq action. On the S&P daily chart, the move finds demand at the FVG below. This demand zone is where price is likely to find support before a potential bounce or further breakdown. The S&P daily chart shows the consolidation at the FVG demand. The market is pausing, trying to decide its next move. Watch for clear direction from volume and price action here. This scene marks the beginning of Section 7, the June 5th setup. We'll analyze the market context heading into that specific day. On the Nasdaq 4-hour chart, we see the price action as of June 5th. Note the key resistance at the 50% line and the presence of supply overhead. The Nasdaq 1-hour chart shows a failed retest of a swing high and a golden FVG overhead. This stack of bearish signals suggests a high probability short opportunity. The S&P 4-hour chart on June 5th shows a clear H pattern. This failed retest confirms the market is rolling over and supports a bearish outlook. The S&P 1-hour chart on June 5th reveals the stack of confirmation, the H pattern, failed retest, and the golden FVG overhead. This offers a clear entry point for a short. This chart shows the entry point for the trade on June 5th, where all signals aligned. The confluence of patterns provides the confidence for the trade setup. The trade management includes the 50% fib stop loss. If price goes above the 50% line, the trade idea is invalidated, and we exit immediately. The target for the trade is the FVG demand below. This is where institutional buying is expected to re-emerge, marking a logical profit-taking area. Here we see the trade execution and the resulting breakdown. The conviction volume confirms that the market is moving as anticipated. The confluence held true. This trade resulted in a swift move to the FVG target. The key takeaway is trusting the confluence of signals and respecting the higher timeframes. Thank you for watching this video. For more information on trading strategies and to join our community, please visit the link provided.